Hello, everybody. Brian with Trinity Capital Partners. Today, I want to tell you why choosing a private lender for equipment financing can be smarter than going to a bank. Let's get into it. First, let's talk about bank limitations. So, banks have a layered underwriting process. This is due to the regulations that they're under. So, you go to a bank, you go to your loan officer. The loan officer will tell you what's needed in order to apply for the loan, application, financial statements, invoice on the equipment, etc. The officer will collect that information from you, look through it, assess it him or herself, and if the loan officer decides that it's worth submitting to underwriting, they will go ahead and package it and send it over to the underwriting department. The underwriting department then starts analyzing the loan request, digging into a little deeper into, the financials, the background, the credit history, etc. If the underwriter determines that it is a loan that the bank would approve, they will put together a report, an analysis report of the loan request. Together with all of the application information, they'll hand that back to the loan officer. The loan officer will then have to take that to a loan committee to present the loan request to that committee to try to get an approval. Now, in some banks, the loan committees meet weekly. Other banks, bi-weekly. If it's a smaller bank with a lower volume, they may not even meet except monthly. So what that does is add significant time to the loan approval process. The other limitation that banks run into due to regulations is lending limits. So they are constantly monitoring their loan portfolio, and what they're looking for is becoming overexposed in a particular industry or with a particular type of loan. They have some limits in order to meet regulations that they have to stay under. So once they hit that limit, they just stop lending on that particular type of loan, and it can change at any time, and it sometimes changes frequently. So let's say you're in the trucking industry, which isn't a great industry to be in to try to get a loan right now anyway, but that's a different subject. If you're in the trucking industry and one of your fellow truckers you were talking to at a truck stop told you a couple months ago he went and got a loan from XYZ Bank, worked out really well. Well, let's say XYZ Bank has been issuing a lot of loans to trucking companies. You go into XYZ a couple of months later, apply for a loan, you're automatically declined. And you can't understand why. You have good credit, you're making money. Well, the reason is that bank has hit their limits of exposure in the trucking industry. So they're going to stop doing truck loans for a while. So you can run into that at a bank and you have no idea when it's coming. It's the heavy regulation that they're under that dictates all of that. And finally, the other thing it dictates is the approval criteria. Banks have specific credit requirements that they have to follow. They cannot deviate from them because it puts them out of their regulatory requirements. So that can also affect a loan decision. So let's talk about the speed of working with a private lender. So private lenders are not regulated, so their underwriting process is much more streamlined. The approvals are based on the whole business situation, so not just the history and the credit. So they look at a few more things they'll take into account when deciding whether or not to issue an approval. You can lose opportunities if you're at a bank waiting to hear back for an approval. With a private lender, you can get things done much more quickly. The flexibility of a private lender means that they generally have much higher approval rates than a bank. Banks have cookie cutter programs, they have cookie cutter requirements. You cannot deviate from them or you're going to get declined. The last statistic that I saw, which I think was a few months ago, the approval rate at banks for small business loans, and those would be those that really fit into kind of the SBA category, the approval rate was 12%. That's less than 1 out of every 8 applications that get approved. That's not, your chances aren't real good under that. I don't know what the number is for private lenders, but I'm very confident that it's a lot higher than 12%. In addition to that, private lenders can give you a decision in days, not weeks. And in fact, I've closed equipment financing deals in less than a week. I closed one in 3 business days. Now, I wouldn't want to promise that for every single loan or yours, but I did get one done that quickly. So let me give you an example of how working with a private lender on a loan can be a big advantage. I had a customer that was an Illinois contract manufacturer of metal parts. They signed or acquired, I should say, a new contract with a new customer that was going to represent an overall jump of 1/3 in their top line revenue. Huge jump, big growth for the company. However, they needed 2 new machines to add to the production line to be able to fulfill that contract. And here was the catch. The customer, their customer, imposed a very tight deadline for delivery of these parts because they needed them in order to fulfill a contract for one of their customers. So I took in the application and the financial information, credit, and all that, did a summary write-up, and submitted in 2 days. So in day 3, we got an approval from the private lender. Got all the documents together for closing. On day 4, we closed it and funded it, and my customer was able to go purchase those machines. What that allowed them to do was get those machines online in plenty of time to fulfill that new contract and basically blow up the size of their business, right? They added 33% to their top line revenue. That never would have happened if they had gone to a bank. So what's the takeaway here? Well, with a private lender, you can leverage your business assets and your particular business situation, in the case of my example, that huge new contract, instead of relying strictly on your history and credit profile like you have to with a bank. Banks focus on credit scores, debt to income and other financial ratios, financial statements. They only look backwards. Credit issues, a limited credit history, or lending limits that we described earlier can lead to declined requests. So here's the question you have to ask yourself. Yes, private lenders are going to be a little more expensive. Is that additional cost worth it? Well, let's start with a question to answer that. How much will it cost you to not have the equipment in time? In the case of my customer in Illinois, it would have cost them quite a bit to not be able to get that equipment in time. And they would have broken the contract that they had. So game over in terms of doing business with that new customer. So the other thing you have to consider is, can I go back to this time and again, and will it benefit me? In the case of that Illinois manufacturer, they plan on using me again, but they didn't mind the additional cost of the loan because they knew that new top line revenue and the profitability were going to more than make up for the additional cost of the loan. So that's something you have to look at. So if you want superior service, faster turnaround, and a better chance of approval, contact me through one of the methods described in the description. That would be my Calendly or my email. And I would love to help you get new equipment equipment online and making money. Talk to you later. Thanks for watching.